Let's get right into it. Investing isn't just for Wall Street pros in fancy suits making complicated deals. It's not some exclusive club. It's a fundamental tool that anyone can use to improve their financial well-being. We're going to demystify the world of investing and show you how accessible and essential it is for everyone, regardless of their background or current financial situation. For most of us, investing is the single most powerful way to build wealth over time. It's about securing your future, achieving your dreams, and creating a financial safety net for yourself and your loved ones. Think of it as planting a seed today that will grow into a mighty tree, providing shade and sustenance for years to come. If you're just saving cash, keeping it under your mattress or in a low-interest savings account, you're actually losing money. Inflation is quietly eating away at your money's value every day. The cost of goods and services rises over time, meaning your savings buy less and less. That dream vacation or that down payment on a house becomes further and further out of reach. Investing is how you outpace inflation and preserve and even grow your purchasing power. It allows you to stay ahead of the curve and ensure that your money works as hard as you do. Investing is how you make your money work for you, even while you sleep. It's about creating passive income streams that generate wealth without requiring your constant attention. Imagine waking up each morning knowing that your investments are working hard on your behalf, building your financial future while you focus on the things you love. The secret weapon? Compound interest. This is where the magic truly happens. It's your money earning money, and then that earned money earning even more. It's a snowball effect that can dramatically accelerate your wealth accumulation over time. The longer you let it work, the more powerful it becomes. The earlier you start, the more time your money has to grow, and the more significant the impact of compounding will be. Time is your greatest ally in the world of investing. That's why starting today is so much better than waiting. Every day you delay is a day of potential growth lost. Don't let fear or uncertainty hold you back from taking that first step. This guide will break down investing into simple, actionable steps, making it easy for anyone to get started regardless of their prior experience. It doesn't matter if you have $5, a small contribution can be the start of something big, or $5,000. The principles remain the same, and the potential for growth is there. The core principles are the same, whether you're investing small amounts or larger sums. We'll cover building a solid financial base, the essential groundwork for successful investing. We'll also focus on understanding what you're buying, empowering you to make informed decisions about where your money is going. And crucially, we'll help you avoid common pitfalls that can derail your investment journey. By the end of this guide, you'll have a clear roadmap, a step-by-step plan to navigate the world of investing. You'll also have the confidence to take control of your financial future, making informed decisions and building a secure future for yourself. So, let's get started. Your journey to financial freedom begins now. Take that first step, and let's build a brighter future together. Before you invest, you need a foundation: education. Don't throw money at the market without knowing the basics. Learn what stocks, bonds, and ETFs are. Understand diversification, risk tolerance, and asset allocation. Spend a few evenings reading, watching videos, or picking up a classic investing book. Know your goals. Are you investing for retirement, a house, or something else? Your timeline shapes your strategy. Be honest about your risk tolerance. Can you handle seeing your investments drop? Think of this as drawing your map before the journey. Education empowers you to make smart, informed decisions. Don't skip this step. It's the most important investment you'll ever make. Build your knowledge before you build your portfolio. Now let's talk about budgeting. It's a term that can sometimes feel intimidating, but it's truly the cornerstone of sound personal finance. Think of it not as a restriction, but as a roadmap to achieving your financial dreams. Budgeting is the solid foundation of your financial life. It provides the structure upon which you can build wealth, achieve your goals, and weather any financial storms that may come your way. Without a budget, you're essentially sailing without a compass. A budget isn't about restriction. It's not about depriving yourself of the things you enjoy. It's not about endless austerity. Instead, it's about awareness and control. It's about understanding where your money is going, making conscious choices about how you spend it, and ultimately, taking control of your financial destiny. To start, track every dollar for a month to see where your money goes. Use a budgeting app, a spreadsheet, or even a simple notebook. The key is to capture every expense, no matter how small. You might be surprised at where your money is actually going. Once you have a clear picture of your spending habits, use the 50-30-20 rule as a guideline. This is a simple yet effective framework for allocating your income. Allocate 50% to needs. These are your essential expenses: housing, food, transportation, utilities, and healthcare. Dedicate 30% to wants. This category includes things like dining out, entertainment, hobbies, and non-essential shopping. And finally, commit 20% to savings and investments. This includes building an emergency fund, paying off debt, and investing for the future. Before investing, prioritize paying off high-interest debt. This is crucial because the interest you're paying on debt can significantly eat into your potential investment returns. Credit cards and payday loans are wealth killers. The high interest rates associated with these forms of debt can quickly spiral out of control, making it difficult to achieve your financial goals. Next, build an emergency fund. This is a safety net that will protect you from unexpected expenses and financial hardship. Aim for 3-6 months of living expenses. This will provide you with a cushion to cover job loss, medical bills, or other unforeseen circumstances. Keep your emergency fund in a high-yield savings account. This will allow your money to grow safely while remaining easily accessible when you need it. This protects you from having to sell investments in a crisis. Selling investments during a downturn can lock in losses and derail your long-term financial plans. Budgeting finds the money, often revealing areas where you can cut back and save. Paying off debt secures your present, freeing up cash flow and reducing financial stress. And an emergency fund protects your future, providing peace of mind and financial security. Only after these steps should you start investing. Investing without a solid financial foundation is like building a house on sand. Master your budget, and you'll master your money. It's the key to unlocking financial freedom and achieving your long-term goals. Your financial base is now set. You've taken the necessary steps to build a strong foundation for your financial future. Let's move on to managing risk. Understanding and mitigating risk is essential for protecting your wealth and achieving your financial goals. Ready? Let's go. Let's talk about risk. It's a word that can evoke feelings of anxiety and uncertainty, but in the world of investing, understanding and managing risk is absolutely crucial. Ignoring it is like driving a car without looking at the road. You might get lucky for a while, but eventually you're likely to crash. Every investment has it, but not all risks are equal. Some investments are inherently riskier than others. Think of it like this. A high-speed roller coaster is riskier than a gentle carousel ride. Both are forms of entertainment, but the potential for thrills and spills is vastly different. Risk is a spectrum, not a switch. It's not simply a matter of risky or safe. Instead, it exists on a sliding scale, with varying degrees of potential gains and losses. Understanding where an investment falls on this spectrum is key to making informed decisions. The key is managing it to fit your goals and comfort level. What might be an acceptable level of risk for one person could be far too much for another. It's about finding the sweet spot where you can potentially achieve your financial goals without losing sleep at night. Higher returns usually mean higher risk. This is a fundamental principle of investing. If someone promises you guaranteed high returns with no risk, run the other way. There's almost always a trade-off. Think single stocks. Investing in a single company can offer the potential for significant gains if the company performs well. However, it also carries the risk of substantial losses if the company falters. Versus government bonds. Government bonds are generally considered to be a much safer investment as they are backed by the full faith and credit of the government. However, the potential returns are typically lower than those of stocks. The best way to manage risk? Diversification. It's a strategy that involves spreading your investments across a variety of asset classes. Don't put all your eggs in one basket. This old adage is particularly relevant to investing. Spread your money across many companies and industries. By diversifying, you reduce the impact of any single investment performing poorly. To protect yourself from big losses, think of it as building a financial safety net. Your risk tolerance depends on your timeline. The longer you have to invest, the more risk you can generally afford to take, and your emotional ability to handle ups and downs. Market volatility can be unsettling, but it's important to stay calm and avoid making impulsive decisions based on fear or greed. If you're young and investing for retirement, you can take more risk. You have time to recover from any potential losses. If you need the money soon, play it safer. You don't want to risk losing a significant portion of your investment right before you need it. Build a portfolio you can stick with for the long haul. Consistency is key to long-term investment success. Diversification and self-awareness are your best defenses. Knowing your risk tolerance and diversifying your investments are two of the most important steps you can take to protect your financial future. Manage risk smartly, and you'll stay in the game. Investing is a marathon, not a sprint. Let's break down what you can actually invest in. We'll explore the different asset classes available to you, from stocks and bonds to real estate and commodities. On to the basics. Understanding the fundamentals is essential before you start putting your money to work. Most beginners need to know three things: stocks, bonds, and funds. Stocks are ownership in a company. If the company grows, so does your investment. Bonds are loans to companies or governments. You get paid interest and your principal back at maturity. Bonds are generally less risky than stocks. Funds, like mutual funds and ETFs, are baskets of many stocks or bonds. Buy a fund and you instantly own a piece of hundreds of companies. Index funds and ETFs are the best choice for most people. Low cost, diversified, and easy to own. No need to pick individual stocks. Let the fund do the work. With just a few funds, you can build a globally diversified portfolio. Simple, powerful, and effective. Now let's see how to get started with just a few dollars. You don't need thousands to start investing, just a few dollars. Open a brokerage account online. Fidelity, Vanguard, Schwab, and others have no minimums and commission-free trades. The process is quick and easy. Can't afford a whole share? Use fractional shares to buy a slice of any stock or fund. This lets you diversify, even with small amounts. The real key is automation. Set up automatic transfers from your bank to your brokerage every payday. This is called dollar-cost averaging, investing a fixed amount regularly, no matter what the market is doing. It builds discipline and removes emotion from the process. Start small, start now, and let automation do the heavy lifting. The habit is more important than the amount. Let's see how this works in real life. Meet Maya and David. Let's make this real with two examples. Maya, 25, has $200 a month to invest for retirement, 40 years away. She opens a Roth IRA and puts everything into a low-cost target date index fund. The fund starts aggressive and gets safer as she nears retirement. She automates her $200 monthly transfer and lets it grow. David, 55, wants to retire in 10 years. He needs stability, not big growth. He splits his investments, 60% in a total stock market fund, 40% in a total bond fund. He rebalances once a year to keep that mix. Maya's plan is for growth, David's is for protection. Both use simple, low-cost funds and automation. The key: match your investments to your goals and timeline. Simple strategies, real results. Now let's avoid the mistakes that trip up beginners. Knowing what to do is just as important as knowing what to do. Don't try to time the market. No one can do it consistently. Invest regularly and stay invested for the long term. Don't let fear or greed drive your decisions. Stick to your plan. Ignore hot tips and complex products you don't understand. If you can't explain your investment in a sentence, don't buy it. Simplicity wins. 1 to 3 low-cost index funds is all most people need. Automate, diversify, and stay the course. Avoid the traps, and you'll build real wealth. Let's talk about the mindset that makes it all work. The final piece is mindset, patience, and confidence. Investing is a marathon, not a sprint. Real wealth builds slowly, thanks to compound interest. Early on, your contributions matter most. Later, your money does the heavy lifting. Stay patient through market ups and downs. Confidence comes from your education and your plan. When the market drops, remember, you're in it for the long haul. Don't panic. See downturns as opportunities. Start today, even with a few dollars. Your future self will thank you for your patience and discipline. Investing is an act of kindness to your future self. Stay consistent, be patient, and trust your plan. You've got this. Now go build your future.